with everybody understanding where Fed rates are ultimately going to land, and where we think therefore debt is going to land, and exit cap rates and things like that. It makes it easier to predict what values should be, and it makes sellers recognize where values should be.
If you're not conscious about your investment strategy, you won't end up where you want to be, not financially or as a human. On this show, we interview highly successful investors and share how they overcame limitations to become unstoppable forces of success. If you're ready to learn what it is to be a conscious investor so you can end up where you want, keep listening.
Conscious investor. Are we ready? Okay, we're ready. Okay.
Oh, I'm ready. Sorry, go ahead.
You're ready? Okay, we're gonna pull this out
I'm
for
ready.
a blooper. We're good. Conscious investor, welcome back. Always grateful to have you joining me here on this show. And make sure the show is here to serve and support you. And I can know better how to serve and support you when you leave a rating and a review. And that review, just leave an honest one and let me know what it is that you would like to learn more about. Let me know how the types of guests that you would like to hear from so that we can get that information to serve and support you in taking your very next step in your investing. And today I have a really special guest. It's really funny. That I didn't learn about syndications or anything despite being in real estate until I was in my 40s. And yet, in my own backyard, in my neighborhood, not literally in my neighborhood, but back in my hometown, Ryan was just crushing it and just developing this entire ecosystem that now serves so many people on such a powerful level. And before I invite Ryan to even speak, I have to let you know, conscious investor, you need to go and listen to Durable Value. It is literally, I listen to tons of podcasts, but it is literally one of my favorite podcasts. I've mentioned it before, and I'm not just mentioning it because Ryan's in the house right now. I'm mentioning it because I know it would bring tremendous value to you. And they only release like one episode a month, which is kind of sad, but it makes you really anticipate the next episode and everything. So make sure you go and subscribe to that and listen to it, because it will help really grow a foundation and an understanding with what's happening in the economy. So Ryan, I want to thank you for creating great podcasts. Thank you for being awesome. And thank you for coming on the Conscious Investor podcast.
Happy to, and glad to be here.
Yeah, super fun, because since I've moved away a million years ago, I haven't seen you or spoken with you in countless years. And then I'm like,
and our paths cross.
Yeah, I'm like, this is what Ryan does. Oh my gosh. So I don't typically ask people to share about their experiences, but your experience investing started at a very unique time, especially considering where markets, are currently and such. And so can you just give us a little bit of a background as to where you started? And
Yeah, happy to. So I'll just background, majored in finance, worked at a hedge fund, moved back to Modesto, started in real estate. And my business partner and I, who have been friends since third grade in Modesto, we decided to start our company and spin off on our own. And we did so at a great time. Not really. December of 2008. So if anyone has been in the real estate business long enough, December of 2008 was pretty much like the precipice, particularly with commercial real estate, because it tends to lag residential real estate a little bit. And so that was the beginning of the precipice. And so we got to start our business and then go on an amazing roller coaster ride. But looking back on that, it was really formative in our experience, because what we realized is there were some really key principles that we learned out of managing through that. And before I mention those, so we started as a third-party property and asset manager and broker. So we were helping other people manage their properties, helping them sell, helping them buy, all in the commercial space. And so you can imagine if we were doing this through the global financial crisis or the Great Recession, that was working with distressed borrowers, that was working with special assets, special servicers, that was going through the foreclosure process as the property manager. And so we were really on the front lines of learning about distress and learning what not to do. And fortunately, at that point, it wasn't our capital at risk. And so that's been, I'd say that two of the key takeaways out of that experience, or three of the key takeaways, are buy right, which we always are looking at relative to replacement cost. So we always try to buy, 30 to 60% below replacement cost. So buy right. The second thing is get conservative debt. And today we look like geniuses given the debt environment, but that wasn't because we're geniuses. It was just because we're too scared. And we've always used fixed rate debt. We've always been fairly low leverage because levering up too aggressively is one of the ways that you build risk. And then the last thing I'd say, and this is more speaking to what we do, maybe not to the passive investor, but add value quickly. And so we're buying properties where we can quickly go in there and create margin of safety and value. So I know that was probably a little longer than you wanted, but I just wanted, that's kind of a little bit of framing of where we started and how that influenced how we invest today.
That's huge. And what's interesting is that I have some shared values there, particularly when it comes to, debt and leverage. Like, I don't know if that was just being scarred from being in, real estate, and Steve had gone into full-time real estate in 2008. And it's like, okay, but in our experience, it was always like never over leverage and always having that fixed debt. And similar to you, we closed on 120 units in Des Moines at the beginning of 2022. And one of the elements that I loved about it was, hey, we've got like a 3.25% fixed rate debt on this. Like, we don't know where the economy's headed, but we know that this is a great rate and it's fixed. What was it about the adjustable rates? They totally scarred me for life, probably, because it was such a bloodbath with those.
Yeah, absolutely.
Jeez. So I appreciate those principles. And actually that really makes me curious. And I love following curiosity about, and since we're speaking about finance and debt, what is your perspective right now if a passive investor is reviewing, and now, let's bring up to speed. I mean, now you're working with large institutional capital and such. Like, you guys have really grown from the beginning to where's your company now?
We're today. So so we started individual syndications back in 2013 and just kind of did deal by deal investments. And then we ultimately evolved into our first fully discretionary fund and raised $12 million and deployed that very quickly, and then raised fund 2, which ended up at about $42 million. We just had our final close on fund 3, which is about $100 million, including co-investment. And now we're launching fund 4. And we're targeting 300 million on fund 4. And so you can tell probably from that size that we're very much the composition of our investor base. It hasn't changed, it's evolved. So many of our, actually, virtually all of our initial investors are still investors of ours. But then we have added on to that investors that have the ability to scale a lot more, because the market opportunity that we see is pretty significant. We focus on institutionalizing secondary and tertiary markets in the West. So these are all the markets, the Bakersfields, the Modestos, we just bought in Orem, Utah. We're buying in Lakewood, Colorado, looking in the Western Oregon area. And these are markets that have been very non-institutional. And so our focus is going into those markets and using an institutional skill set and approach and deploying. And so today we have about $500 million in assets under management. We have a team of about 50 or 55 people. We're growing from there because we see this as a great opportunity.
Oh my gosh, opportunity is coming. Conscious investor, you might be feeling like, oh my gosh, like that's so much. I just had I've just found my 50,000 for my first investment. But listen, did you hear the time span, 2008 to present? Like, we all start somewhere. And so your willingness to get started and take action and to be diligent and consistent has a compound effect. And so, I want to encourage you.
Our first investment was a $300,000. That was the purchase price. So the equity was 120,000 maybe, and it was a restaurant bar with a residence above it in San Leandro, California. So
wow,
that's where it starts.
There is a starting point for everyone in what they are doing.
Yep.
So what's interesting with this, and so going down some of the I have like tons of curiosity, but oftentimes people have been scarred from Gen Xers. We're a little bit scarred from the Great Recession. And I think some millennials saw their parents go through the Great Recession and also face some collateral damage there. And so when we're looking at debt or we're looking to place an investment, what would you say they should be looking for as a passive investor looking at a deal that's being offered to them?
Them investing directly. So I would say we generally have found the most luck or consistency with community and regional banks, especially as the markets have changed. We certainly are of a size where we can be working with any of the top banks. And we have some relationship with some of those top banks, but we just have definitely found that community regional banks for real estate investing, that really is your best avenue. You're also most likely to find fixed rate debt and, I would say a conservative leverage, that sort of thing. So I would definitely focus in that direction.
Definitely, that's great advice. And if somebody was saying, like, let's just say you open up your fund, you have a fund, and they're reviewing, what does this fund look like? What's the composition? Or they're even more specifically reviewing a syndication that's coming across, their inbox, and they're looking over it. And you and I know, they're all good deals. Look at my deal, like invest with me. Everybody's like carting their deal around as if it's great, and they're not apples to apples usually. And oftentimes it comes down to that debt. Is there anything that you would look at as a passive investor?
I've heard the term financial engineering. So, some investors or some managers, they use financial engineering to yield a return. And so they're working on how do we get the most aggressive leverage possible? How do we have the lowest possible rate? And sometimes that ends up being a variable rate because you can get a lower rate when it's variable. And so I would definitely, be looking at kind of what are the assumptions on debt and leverage. We are definitely primarily focused on the institutional arena, and institutions are sharp. Right. So the parameters that we have within our fund docs, they actually put boxes. We put boxes around what we can and can't do. So for instance, portfolio-wide leverage can't be more than 65%. Our portfolio leverage right now is at about 54%. Any given deal, we can't have going in leverage higher than 70%. And these boxes are boxes that we're very comfortable with because this is how we operate, but this is how institutions look at debt and leverage.
Important. It's really important. So when you're looking at that, offering memorandum that's coming to your inbox and somebody's touting it in the subject line, this is the best deal, these units, 120 units, best deal ever. Like, you got to look under the hood you have to be looking at how they're structuring their debt.
Yep.
It's so important. What are some other things that you would say if you could go back in time to, like 5 years into your investment journey? What are some elements that you would say would be really important for newer passive investors, like questions or things that they should be looking for?
Yeah. Definitely the most important thing, and any sophisticated investor knows this, is underwriting the manager, knowing the manager, because at the end of the day, we're in the trust business, and no matter what the financial returns appear to be, no matter what the strategy appears to be, at the end of the day, whether it be an institution or an individual, they're giving you their hard-earned money that they're entrusting you with. And so the first thing always has to be evaluation of that manager and who they are and your comfort level with them, whether it be references or other resources or any sort of due diligence that you might do. I would say that's definitely key, because, and Julie, I'm sure you experienced this too, but fundamentally, we don't lose investors. The reason we don't lose investors is because they trust us and we've delivered on that trust. And so the longest process that a passive investor should take is evaluating the manager, and then start to think about the deal or the fund or whatever the case may be, but start with evaluating the manager.
I'm always like, you always hear it, bet on the jockey, not the horse, like, know who's at the helm of this ship. There are so many different ways I've heard people say it, but I agree completely, absolutely, completely. As you guys are looking in, and I know some of this just by the nature of the one podcast episode that you guys release each month, that, so some of you are thinking on this, but, as you guys are looking at the economy and well, the fact that you guys are opening up another fund with 300 million, that sounds like a lot of fun for what's coming up ahead, but what are you guys anticipating? How could a passive investor really become strategic? Because they don't want to be hands-on like us doing fun, like behind the scenes fun. What do you see coming, in your opinion? No crystal ball, but like just over the next few months, what kind of advice would you have for them? How could they really prepare themselves and position themselves for a strong 2023?
So I don't normally say this because it would come across insincere if it was like, hey, it's always a great time to be investing. The reality is that I would say the last 9 months have been very challenging to be an investor. As professional investors, which we are, it's been challenging. It's been rewarding. We've been able to find some great investments, but it is not for the faint of heart, and it's not for the non-professional. As we get into 2020, and the reason for that, by the way, is because interest rates go up, and when interest rates go up, all of a sudden the price that we all can pay goes down. And sellers don't recognize that. And so it's called price discovery. We've been in price discovery for the last 6 or 9 months. We anticipate that to be settling itself out at toward the beginning of this year, with everybody understanding where Fed rates are ultimately going to land, and where we think therefore debt is going to land, and exit cap rates and things like that. It makes it easier to predict what values should be, and it makes sellers recognize where values should be. So I would characterize 2023 as kind of a year where the market activity starts again. It's also, compared to a year ago, it's probably 10 to 15% cheaper than it was a year ago, maybe 20% in certain circumstances or asset types. So in that sense, it's a value, but part of the reason that it is that it's a decreased value is because you're having to pay for higher debt cost. So the benefit of a year ago is you had cheap debt, And today you get a discount on your price because you don't have cheap debt.
I always think that the little adage, they're gonna get you, like one way or another. We never have everything all at once. Like it is,
Mhm.
interest rates are really great, but prices are higher. Interest rates are higher. I mean, like we have all
Yeah.
this discrepancy
Yeah.
taking place. I'm looking ahead and wondering what's going to happen with capital and like where the finance markets and such, because
Mhm.
I remember, and I'm sure you do too, it's like the finance market just dried up. It was like,
Yeah.
like,
Yeah.
no, we have
Yeah.
nothing, and it's going to be really hard. So I'm
Yeah.
wondering over the next like period of time, I'm like, I wonder what that looks like, and where's capital going to become, and how are like,
Yeah. I mean, that's a little crystal ball, so I'll caveat it with that. But
yeah.
I don't see, I mean, we've definitely seen underwriting change. We've seen lender appetite change.
Mhm.
But the changes that we've seen, at least, maybe it's because of the markets where we operate or the relationships we have or whatever. The changes haven't meant, oh my gosh, I can't find financing. What it has meant is the leverage that I thought I was going to get changed. The
Mhm.
lenders are willing to lend at 55% instead of 65%. It means the interest rate changed. Some of the other terms may have changed, but we definitely haven't seen a complete pullback. I have heard on the securitized debt side, like CMBS loans and things like that, Wall Street debt, I've heard there it has actually kind of seized up a little bit more. But I think as we roll into a recession, which I think we're likely to have a light recession, it's likely that lenders will continue to tighten those standards. But the big difference is that when we were in 2008, we were, and we probably didn't realize it at a time, but we were at a precipice. When you look at values, when you look at interest rate and the broader economy, we had a deep dive. And I think general consensus is that what we're looking at ahead of us is a dip, but it's not a significant dip. So I don't think we'll see the lender seize up the way that they did.
Be
But
nice
that's
if
crystal ball. So I mean, who knows?
crystal ball, it's kind of fun to have crystal balls come about here and there, and you do never know, but it's important to look at the past, internalize it, and strategize as best you can for what is, may come, worst case scenario,
Yeah.
which can be the best case scenario for purchasing. So
Yeah.
it sounds like with another fund, you guys are
Oh, yeah.
continuing to be
Yeah,
bullish on
we think,
purchasing.
yeah, we do think there are going to be a lot of opportunities. We don't think it's going to be high levels of distress, but there are absolutely borrowers who have debt circumstances that require them to act differently than they would otherwise. Again, I don't think it's going to be to the magnitude that some people may predict. But we definitely like the market because we felt that a year ago the market was very frothy and had all the indications of being kind of a peak white hot market. Frankly, it was that way for the last 3 years at least, maybe the last 5 years, you could argue. So it's kind of nice to get into a market that's a little more rational. The other thing I was just thinking about, because you had mentioned about the passive investor looking at, pitch decks or whatever the case may be. And I would say when we're buying, especially in an environment like right now, I would argue that we've always thought this way, but even more so, we're underlining it now, is we are not buying based on what we think will happen or could happen in the future. And that's really important because a lot of investment underwriting, it's predicated on future variables, and namely, the two big future variables that any investor should be looking at is rent growth and exit cap rate, because you can change those two and it makes the returns go to the moon, or it makes the returns go to the ground. And so I think it's really important that as people are looking, especially in this environment, if you've got an investment where they're underwriting, oh, we've had, 8% annual rent growth for the last 5 years, and so we have that projected out for the next 5 years. Well, I'm glad that you're so optimistic. Or hey, cap rates have traded for the last 5 years at 4.75%, and so we have that underwritten for our exit cap rate 5 years from now. These are the kind of things that when we're buying, because we're a value add, by the way, that's our strategy. So we go in, we improve properties, bring them to market rents, and then sell them. And so in that value add space, we're always looking at buying properties where we can add value immediately, not where we're basing it on some future rent growth. So it's always properties where the in-place rents are 15 to 30% below market. And there's some, functional problems or physical problems with the asset that allow us to come in, improve it, and bring those rents to market. So it's not, especially in an environment like this, you don't want to be basing your returns on, future growth.
Potential, that it's such a killer, and a lot of people will try to engineer the deal that they want, and it's like you can pull all the levers on your underwriting spreadsheet and everything, but at the end of the day, like, what's going to hit in the investor accounts, like it's your reputation on the line. That's that trust that you were talking about. Like, you are breaking trust if you're not being grounded in your thesis and such. I love it. It's like, don't pay for blue sky. Like, you have no idea what is out there. What do you think with rents? I was reading an article, and it was, showing some markets where rents were actually declining and such. I'm like, I keep reminding people, rents don't just go up, they can go down. And you talk with some investors that, I mean, it's just interesting to see, like, no, you can't just be banking this on like the blue sky and that it could go up. Like, what if it goes down? Then what?
Yeah. And that's where I would encourage investors to drill down into rent growth, into exit cap rate, and probably into market rent. Those are probably the three variables that are the easiest to manipulate, would be an extreme word, but to be optimistic about would be a nice way of saying it.
That's a gracious way of saying it, for sure. That's a very gracious way of saying it. What are some, do you have any other, I mean, you have so much to draw upon, Mike. My mind is just like, I have so many questions, but you probably have some instances or some things that you've seen passive investors where they failed to take that next step. I was like, I'm going to hold a crystal ball here. Ryan, have you ever had a really solid deal and had an investor say, no, I'm just too scared?
Absolutely.
Exactly.
Just not those words, because we're dealing with institutions for the most part. I mean, but yeah, I mean, we have that we probably had that happen last week. I mean, it's pretty regular, because what ends up happening is they just, for whatever reason, in the current market environment, that particular thing is not what they're looking for, or they're assigning, a risk premium to that market, to that asset, whatever the case may be. Every investor has different appetites in that regard.
How about some of your investors when you first started, at the beginning, the genesis, when you're buying a $300,000, smaller place and everything, and as you were growing, how did you encourage investors that were nervous? They knew it was a good opportunity, but they were on the fence and they were nervous. Like right now, investor sentiment, particularly with, and I mentioned, like, I have a heart for that middle class that's just getting squeezed on both sides of things, and they really need the benefits of this investment strategy. And it's uncomfortable. It's something new to a lot of these investors. It's new to them, and that discomfort sometimes prevents them from taking action.
I would say we don't really delve into that too much, because most of our investor base is pretty sophisticated. So if they're, like I mentioned, if they're not doing a deal, it's from some fairly rational reason why. It can be influenced by emotion, but it's not as much so as kind of like what we would call like a retail investor. I mean, frankly, that's a big reason why we steer clear of that, because it is hard to, we're not in the business of counselor or persuader. We just we do what we do well, and if people understand and they like our strategy, they like our track record, they like what we do, then they invest. But we're not, especially in a market like this, whenever it's uncertainty is high. This is absolutely, I'm sure there are lots of Warren Buffett quotes around this, but when uncertainty is high, that is when the professional investor gets to work, and that is when the passive investor sits on the sidelines and misses out on opportunity. So I would just say, like, generally if you're a passive investor, generally it's a good idea to, when you're scared, you should be investing. And when you're feeling like everything's going great is when you should be thinking about taking chips off the table.
That's great advice. That's super great advice. I'm already thinking of a couple of people that I need to connect you up with, by the way. I'm like, oh, these people would be right up your alley. So, we're going to wrap things up. And I know Conscious Investor, it's always sad at the end of a show when we're wrapping things up, but I would just want to say thank you so much for your time. It's super fun. It's inspirational to just like see what you and Joe have built, and to actually, a lot of times I can't tell you what my brothers actually do. I can't tell you what their careers are. I can't tell. A lot of times we can say, oh yeah, I know so-and-so, they're in real estate or they're in this, but we don't really understand. And I do not, we obviously know I'm not at the institutional level. We've already established that, but just to like have an idea and an essence of what you do is just like, it's so cool what you and Joe have established there in Modesto. And it's amazing how many amazing things are in Modesto. Every time I look back, I'm like, Colleen, it's pretty.
And you and I talked a little bit about this before, but we're called a private equity real estate firm. So that's we invest much like private equity does in companies. We do the same in real estate. So we're finding broken real estate or real estate that has untapped value, and we're buying it, we're fixing it, and then we're selling it. Most of the firms that do what we do and do it at scale are based in New York, LA, San Francisco, Chicago. And it's just very uncommon, much like I mentioned, Warren Buffett's based in Omaha, we're based in Modesto. It's very uncommon that the business that we're in to be based in Modesto. That being said, that's kind of a competitive advantage because our strategy and our focus is around secondary and tertiary markets of the Western US. So we are in the Modestos, the Bakersfields, the Albuquerque, New Mexicos, that sort of thing of the world, because those are the markets that are under the institutional radar for the most part. And there tends to be a lot better opportunities in those markets. And so it does, being in Modesto actually has, it's a strength when it comes to the particular investment focus that we have.
That's really cool.
Yeah,
really cool.
Thanks.
Well, thank you again for coming on the show. If people are curious and they're like, wow, what does Graceada Partners actually like? This sounds really cool. I want to learn more about it. They're inspired, or they want to be part of this in some capacity because they are super ultra sophisticated and awesome. What's the best place for them to get in touch?
Yeah, so I'd say on our website, we do every 3 weeks, we have an email called Graceada Insights, which talks about a lot of key themes in real estate and in our markets. So I'd say that's a great way to get in touch with us. If you go online, you subscribe to that, that'll give you a sense of, who we are and what we do. And then we are launching Fund 4, as I mentioned right now. It looks like our minimum investment at this point will be $100,000. So there may be people that are interested in that or not, but certainly just reach out via our website and we'll be happy to reach out to you.
And by nature of how that is being shared, accredited investors only. So, and, conscious investor, if you're still learning about those nuances, you can head over to the YouTube channel and there's a breakdown for you and everything. But, just know thy space. And again, thank you so much. Conscious investor, make sure you hop onto that newsletter, because just reading and ingesting like well-written, well understood information about real estate is going to help grow you. And it's just these little tiny steps that start stacking on top of each other. So subscribe to that email list. And then if you're accredited, this is a great track record and a great opportunity. I would highly recommend that you head over and that you start reviewing, Fund 3 and the opportunity that might hold for your investment portfolio. And finally, make sure you go and subscribe to Durable Value. The podcast is absolutely phenomenal. It's great information. And you and Joe do such a great job. Your conversations are also very fun to listen to. So it's like you get to listen to a fun conversation, but it's actually a really hearty conversation surrounded, focused on real estate investing. Until next time, conscious investor, live big, love bigger, and do great things. What's the big deal about investing in apartments? Why is it better than investing in a slew of single-family homes? I've compiled a lot of information on why investing in a multifamily, also known as apartments, will help you reach your investment goals. Head over to 3keysinvestments.com and download the Why Invest in Multifamily guide today.